Silver just rallied 2% to $82 per ounce. But the reason behind this move is absolutely terrifying for the US economy. December retail sales data just dropped, and it's a complete disaster. Zero growth, flat, stalled. During the holiday shopping season, when retailers make most of their annual profits, American consumers stopped spending entirely. This hasn't happened in years, and it's sending shockwaves through financial markets. The Federal Reserve is now being forced to consider even more aggressive rate cuts as the economy shows clear signs of cracking. Consumer spending makes up 70% of GDP, and when it stops, everything stops. Stay with me because what I'm about to reveal about the retail sales crash and its impact on silver prices could completely change your investment strategy. Welcome back to the channel, and if you're new here, hit that subscribe button right now because we're bringing you the most critical precious metals and economic updates every single day. Today is February 14th, 2026, and we just received some of the most alarming economic data in recent memory. Silver is responding by rallying to $82 per ounce, up 2% on the day, and I'm going to explain exactly why this metal is positioning itself for a massive breakout based on what's happening in the real economy. Let's start with the headline that's sending tremors through Wall Street. December retail sales came in completely flat, 0% growth. Economists were expecting an increase of 0.4%. They missed by the entire amount. This wasn't a small miss. This was a complete whiff. And remember, December includes Black Friday, Cyber Monday, Christmas shopping, and all the holiday spending that traditionally drives retail revenue. American consumers simply did not show up this year. Now, some analysts are trying to spin this as just one bad month, but when you dig into the details, the picture gets much worse. The control group, which is the component that feeds directly into GDP calculations, actually declined by 0.1%. That's not flat, that's negative. It's a contraction. This control group excludes volatile categories like autos, building materials, gasoline, and food services to give a cleaner read on underlying consumer demand. And it dropped. Let me put this in context for you. Consumer spending represents about 70% of the entire US economy. When you hear about GDP growth, the biggest driver by far is household consumption. Americans buying stuff. When that stops, the economy doesn't just slow down, it contracts. We could be looking at negative GDP growth in the first quarter of 2026 if this trend continues. That would technically be a recession. The Federal Reserve is watching this data very carefully, and they're starting to panic. Just 1 week ago, markets were expecting 2 rate cuts for 2026. Now, after this retail sales disaster plus weak job openings data, plus disappointing private payroll numbers, markets are pricing in 3 full rate cuts. And some analysts think we could see 4 or even 5 cuts if the economic deterioration continues. Why does this matter for silver? Because silver thrives in exactly this type of environment. When the economy weakens and the Fed starts cutting rates aggressively, several things happen simultaneously that are bullish for precious metals. First, lower interest rates make non-yielding assets like silver more attractive. Second, aggressive Fed easing signals economic distress, which drives safe haven demand. Third, rate cuts typically weaken the dollar, making dollar-denominated commodities like silver cheaper for foreign buyers. But there's another dimension to the silver story that most people completely miss. Silver is not just a monetary metal like gold. It's also an industrial metal with critical applications across multiple sectors. And here's the fascinating contradiction. Even as consumer retail sales collapse, industrial demand for silver continues to accelerate. How is that possible? Because the industries driving silver demand right now are not consumer discretionary. They're structural and essential. The artificial intelligence boom is creating massive demand for data center infrastructure. Every major tech company is racing to build computing capacity for AI applications. Microsoft, Google, Amazon, Meta, Tesla. They're all spending tens of billions on data centers. These facilities require enormous amounts of silver for electrical components, circuit boards, thermal management, and power distribution systems. Silver is the most conductive metal on Earth, and there's no substitute for many of these applications. The solar energy transition is another huge driver. Despite economic weakness in consumer spending, the global shift toward renewable energy continues because it's being driven by government mandates and corporate sustainability commitments, not consumer choice. Solar panel production consumes between 10,000 and 14,000 tons of silver annually. That's up to 41% of total global silver production going to just one industry. Electric vehicle production is ramping up globally. Each EV uses significantly more silver than a traditional internal combustion engine vehicle. The electrical systems, battery management, charging infrastructure, all of it requires silver. As automakers transition their fleets to electric, silver demand from this sector grows exponentially. Let's dig deeper into what the retail sales collapse actually means for different sectors of the economy. The breakdown by category is revealing. Electronics and appliance stores saw sales decline. Furniture stores were down. Sporting goods, hobby, and bookstores fell. These are all discretionary categories where consumers can delay purchases when they're feeling uncertain about the economy. But the declines weren't limited to discretionary spending. Even some essential categories showed weakness. Department stores, which have been struggling for years, saw further deterioration. Clothing and accessory stores were weak. The only bright spots were gasoline stations, which saw higher sales due to rising fuel prices, not higher volumes, and food services, which barely stayed positive. When you strip out the categories that are just reflecting higher prices rather than higher real demand, the underlying picture is extremely weak. What's causing this consumer pullback? There are several factors at play. First, Americans are tapped out financially. Credit card debt hit a record $18.8 trillion according to the New York Federal Reserve. Serious credit card delinquencies climbed to 12.7% in the fourth quarter of 2025, the highest level since 2011. People are maxed out on their credit cards and struggling to make payments. Student loan payments resumed after a multi-year pause during the pandemic. That's pulling billions of dollars out of consumer spending capacity every month. Auto loans are at record levels with many borrowers underwater on their vehicles. Mortgage rates, while they've come down from the peak, are still elevated compared to the ultra-low rates of 2020 and 2021. Housing affordability is at the worst level in decades, trapping people in their current homes and reducing mobility. Real wages, when adjusted for inflation, have been essentially flat or negative for many workers. Yes, nominal wages have gone up, but prices have gone up faster. The average American can buy less with their paycheck today than they could 3 years ago. That's a huge problem for an economy dependent on consumer spending. Eventually, people just run out of money and have to cut back. The psychological factor is also important. Consumer confidence has been declining. People read the news about layoffs in tech, about companies cutting costs, about economic uncertainty, and they get nervous. When consumers get nervous, they delay big purchases, they build up savings as a precaution, and they reduce discretionary spending. This becomes a self-fulfilling prophecy where fear of economic weakness causes spending to decline, which actually creates the economic weakness everyone was worried about. Now, how does all this connect to silver rallying 2% today? The market is making a clear judgment that this weak economic data is going to force the Federal Reserve to cut interest rates more aggressively than previously thought. And historically, aggressive Fed rate cutting cycles have been extremely bullish for precious metals. Go back and study every major rate cutting cycle since the 1970s. Silver and gold outperformed during these periods almost without exception. The 2001 to 2003 rate cuts saw silver rally from $4 to over $8. The 2007 to 2008 financial crisis cuts sent silver from $10 to nearly $50 by 2011. The 2019 rate cuts sparked a rally from $14 that eventually took silver to over $120 by January 2026. The pattern is consistent and clear, but there's more to the story. Silver's rally today is also being supported by technical factors. The metal is holding above a critical Fibonacci retracement level at $81.85. This is the 38.2% retracement of the rally from the lows to the $121 high. When a market tests a major Fibonacci level and holds, it's often a sign that the uptrend remains intact, and the correction is just a healthy pause before the next leg higher. Trading volume in silver has been elevated, showing strong participation from both retail and institutional investors. The futures market is showing improving sentiment with open interest remaining high despite the recent volatility. Options activity indicates that traders are positioning for higher prices in the coming weeks and months. The put-call ratio has normalized from the extreme levels we saw during the panic, suggesting that fear has subsided and greed is starting to return. Physical silver demand remains extraordinarily strong despite the price volatility. Coin dealers across the United States and Europe are reporting difficulty sourcing inventory. Premiums over spot price remain elevated, often running $2 to $4 per ounce above the futures price. When premiums are high, it signals tight physical supply and strong end-user demand. This divergence between paper markets and physical markets is one of the most bullish indicators for silver. Let's talk about the supply side of the silver equation, because this is where things get really interesting. The Silver Institute, which is the authoritative source on silver market data, reports that the global silver market is in its 6th consecutive year of deficit. A deficit means that total demand exceeds total supply from mining and recycling. This gap has to be filled by drawing down above-ground inventories. For 1 or 2 years, a deficit can be managed through existing stockpiles. But 6 years in a row, those inventories are getting depleted. We're running out of easy silver to access. And here's the problem. You can't just turn on more silver production like flipping a switch. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. The economics of those base metal mines determine whether silver gets produced, not the silver price alone. Primary silver mines, which produce silver as their main product, account for only about 30% of global supply. Most of the easy high-grade silver deposits have already been found and mined. New discoveries are increasingly in remote locations or at depths that are expensive to access. It takes 7 to 10 years on average to bring a new mine from discovery to production when you factor in exploration, permitting, financing, and construction. This means that even if silver prices go much higher, supply can't respond quickly. The industry is structurally constrained. Meanwhile, demand keeps growing. Industrial demand is projected to increase by 3 to 5% annually for the next several years, driven by solar, electric vehicles, 5G infrastructure, and artificial intelligence data centers. Investment demand is also rising as more investors recognize silver's dual role as both an industrial metal and a monetary asset. The math doesn't work. You can't have demand growing 3 to 5% per year while supply grows 1% or less and maintains stable prices. Something has to give. Either prices need to rise significantly to ration the available supply, or we need to see demand destruction where industrial users find substitutes or reduce consumption. Given silver's unique properties and the critical applications it serves, demand destruction seems unlikely in the near term. Now let's address what happened with the massive silver crash from $121 to $71 that we witnessed just 2 weeks ago. Many people are still traumatized by that move and wondering if silver is too volatile to invest in. Let me explain what actually happened because understanding this is crucial for managing your expectations going forward. The crash was primarily a forced liquidation event in the futures market driven by margin increases. The CME Group, which operates the COMEX futures exchange where most silver price discovery occurs, raised margin requirements from 11% to 15%. That might not sound like a big deal, but when you're trading with leverage, it's enormous. A trader who had $10 million of silver exposure with $1.1 million in margin suddenly needed $1.5 million. That's an additional $400,000 they had to come up with immediately. Many traders couldn't meet those margin calls. They were forced to sell their positions, which drove the price lower, which triggered more margin calls for other traders, which caused more forced selling. This created a cascade effect that had nothing to do with fundamental supply and demand. It was purely a technical liquidation driven by exchange rule changes and leverage. These types of events are scary when they happen, but they also create incredible buying opportunities for those who understand what's occurring. The physical silver market barely budged during the entire crash. Premiums actually went up at coin dealers because demand surged from buyers who recognized the opportunity. Industrial users were scrambling to secure supply. Central banks continued their gold buying programs without interruption. The disconnect between paper price and physical reality was stark and obvious. U.S. Treasury Secretary Scott Bessent tried to explain the volatility by blaming Chinese traders and calling it a speculative blow-off. But that narrative falls apart when you examine the evidence. If it was just speculation, why did physical demand remain so strong? Why did China's central bank continue buying precious metals through the entire correction? Why are supply deficits persisting? The attempt to dismiss the rally as mere speculation is either ignorant or dishonest. The truth is that silver went from $4 in 2000 to $121 in 2026 for fundamental reasons. Global money supply has exploded. Government debt has skyrocketed. Industrial demand has surged. Supply has remained constrained. These factors haven't changed just because there was a violent correction driven by futures market mechanics. Looking ahead, what can we expect for silver in the coming weeks and months? The technical setup is actually quite bullish, despite the recent volatility. Silver is forming what technical analysts call a higher low pattern. The previous significant low was around $71 during the crash. Now silver has pulled back to about $79–80 and is bouncing. If this low holds above the previous low, it confirms an uptrend. The next resistance levels to watch are $90, then $100. Getting back above 100 would be psychologically very important and would likely attract significant new buying. Many traders who got stopped out during the crash would re-enter the market. Media attention would increase. Retail investor interest would surge. Breaking above the previous high of 121 would open the door to much higher prices, potentially $150 to $200 based on some technical projections. But we have to be realistic about volatility. Silver is not going to go up in a straight line. There will be pullbacks, shakeouts, false breakouts, and periods of consolidation. If you can't handle 20% corrections in your position, silver is probably not the right investment for you. This is a volatile asset that rewards patience and punishes weak hands. The key is to focus on the long-term trend rather than getting shaken out by short-term noise. The fundamental case for higher silver prices remains compelling. Let me summarize the key points. The global silver market is in its 6th consecutive year of deficit, with no solution in sight. Industrial demand is growing at 3 to 5% annually, driven by solar, electric vehicles, 5G, and AI infrastructure. Mine supply is only growing at 1% or less due to depletion of existing deposits and lack of new discoveries. Investment demand is increasing as more people recognize silver's value. Central banks globally are diversifying away from dollars and into hard assets. China just bought gold for the 15th consecutive month. Other central banks from India to Poland to Singapore are accumulating precious metals. While most of this buying is focused on gold, silver benefits from the broader narrative of monetary debasement and loss of confidence in fiat currencies. As gold goes higher, silver typically follows with higher percentage gains due to its smaller market size and higher volatility. The macroeconomic backdrop is supportive. The Federal Reserve is cutting rates, the economy is weakening, inflation remains above target, and government debt continues to explode. The U.S. national debt just hit $38 trillion. Annual deficits are running over $2 trillion with no fiscal discipline in sight. This is the environment where hard assets like silver thrive while paper assets struggle. The retail sales collapse we discussed earlier is just the beginning of what could be a much broader economic slowdown. If consumer spending continues to weaken, we could see negative GDP growth, rising unemployment, corporate earnings disappointments, and potential stress in the financial system. The Federal Reserve's response will be to cut rates aggressively and potentially restart quantitative easing. This would be rocket fuel for precious metals. So what should you do with this information? First, understand that silver is a long-term strategic position, not a short-term trade. If you're trying to flip silver for quick profits, you're going to get chopped up by the volatility. But if you're accumulating physical silver as a store of value and inflation hedge with a multi-year time horizon, the current price level around $82 looks attractive given where this market is likely headed. Second, focus on physical ownership when possible. The crash showed us the difference between paper silver and physical silver. Paper markets can be manipulated through margin changes, short selling, and high-frequency trading. Physical silver in your possession can't be margin called, can't be hypothecated, and can't disappear through some counterparty failure. Whether it's coins, bars, or allocated storage, having actual metal gives you true ownership. Third, dollar cost average rather than trying to time the perfect entry. Silver is too volatile to predict short-term moves accurately, but by buying regularly over time, you smooth out your entry price and remove the emotional stress of trying to catch the exact bottom. If silver pulls back to $75, great, you buy more. If it rallies to $90, you're glad you already have a position. Fourth, stay informed and don't panic. Follow the actual data, supply and demand fundamentals, central bank policies, economic indicators, and physical market conditions. Ignore the noise from mainstream media that often has ulterior motives. Make decisions based on facts and long-term trends rather than emotional reactions to short-term volatility. That's your complete breakdown of silver at $82 after a 2% rally and the shocking U.S. retail sales crash. If you found this analysis valuable, smash that like button, subscribe to the channel, and drop a comment with your silver price prediction for the end of 2026. I'll see you in the next video.